maximize tax deductions for rental properties. Hi everyone, it's Nicole again. I am back to talk to you about rental properties. I'm a tax advisor with Robert Hall & Associates, and today we're going to talk about maximizing your tax deductions for a rental. Rentals are amazing, amazing assets. I strongly believe in them as an asset and highly, highly encourage people to invest in rental properties. There are multiple ways you can invest into rental properties, and it doesn't even need to be in your home state, especially if you live in like an expensive state like mine. It might be better for you to buy a rental in a different state that's more affordable than your primary residence because you can't afford that. So let's get into it. First, make sure you guys like and subscribe. Don't forget that. That's very important for you to stay up to date with our videos because we're putting them out and they're very important. We're going to talk today about rental properties, acquiring a rental property, and then what's the benefit of a rental property? How can you use this in your tax return for your benefit? We're going to talk about passive losses and active losses. We're also going to talk about real estate professional, and we're also going to finally talk about cash flow because this is a huge, huge thing. Oh, did I mention also depreciation? Oh my God, there's so much to talk about. Cash flow, depreciation, passive losses, real estate professional. We have no time. Let's get into all of these topics. Okay, so you got a rental property. This is absolutely amazing. Let's first talk about cash flow. We're going to change the order up a little bit. Cash flow is a really, really important thing. When you have a rental property, it's so important to make sure your rental cash flows. What does that mean? After all the expenses that you have for the rental, that includes the mortgage payment, that includes the property tax, homeowner's insurance, the repairs, all of the stuff, the gardener, all the crap, the manager, which I don't really like managers. I think you can do it yourself. What else do you pay for? If you ended up having to pay utilities, if you ended up having to pay a broker fee or any of these expenses, after all of these expenses, do you have a profit in your pocket? Meaning, I had collected $50,000 of rental income, and I spent $40,000 in expenses. So I will have a $10,000 profit. Don't worry, on your tax return, you're not going to actually probably show a profit. You're going to end up most likely showing a loss. But we're going to get into that when we talk about depreciation, passive losses, and real estate professional. So, but you want to make sure it cash flows because the whole point of having a rental is that, one, it's a great asset. It's one of the strongest, most consistent growth assets that anybody can have here in the United States. I strongly believe in them, especially for diversification. If you have multiple rental properties and the stock market goes up to the crap that it likes to go up to, it's okay because you have this really strong asset. You might not be able to get out of the rental property as easily as you can sell stock, but you can get out of the rental property as well. And so it's just a really great savings account for the money that you have. Just think of it as like a really great savings account. Benefit one, and it's appreciating, especially depending on where you get your rental, but make sure you understand the market and make sure that you understand the type of rental that you're getting. Is it a class A, class B? You need to make sure you understand these things, especially if it's your first rental. You don't want a fixer-upper like that. No. You don't want to get a rental with a tenant already in it. People think that's wonderful. You don't have to find a tenant. No, because the rent that the tenant is going to be has been paying is going to be lower than what you will be able to charge for a new tenant. And then also there's probably going to be issues like having an existing tenant is very, very difficult. So you want to make sure that you can get the place vacant, and you want to make sure that it cash flows. You understand if you're getting a mortgage, how much is that mortgage payment? How much is the property tax? How much is in the insurance? How much do you need to put away for repairs and things like that? And then you also need your own personal savings, because let's imagine you lose your job. If the rental can sustain itself, that's wonderful. If it nets out to zero, that's not what we want. We want it to cash flow. We want for you to have a profit at the end of every month. Are you going to have a $10,000 profit every month. No, like that's ridiculous. Regardless of how much you're charging in rent, like that's not the average rental. I mean, if you have like multifamily and stuff like that, yeah, it can happen. We'll talk about Airbnb as well. You are going to be looking for that. Make sure it really actually depends on your game plan with the rental. Like, for example, my family and I have several rental properties, and our game plan is a little bit different than maybe most people's. And we're doing it for long-term gains. We acquire rental properties so that we are going to eventually buy a very large apartment building or multiple very large apartment buildings. And so our game plan is the long term. We're not necessarily looking for every rental property to maximize the cash flow. We're looking for longevity. And so the tenants, the rent that I charge the tenants, the length of the lease that I give the tenants, the deposits that I require from the tenants are more based on long term. I don't want somebody there for a year. I want somebody there to feel like it's a home, and I mean, for different reasons. But because we're looking for long term, I don't need to if you sign a 2-year lease, they're locked into that price for 2 years, but I want them long term. So as long as they show a profit, that's amazing. I don't need it to be the maximum, and I don't need to increase rent every year. But if you're outside of the lease terms, you should always be increasing rent, regardless of who your tenant is, because your county or your area could get changed to rent controlled in seconds, and it's such a hassle to increase rent. They need to be comfortable with it, just like your job should be comfortable with giving you a raise on a regular basis. It's the exact same thing. Inflation is a thing. You're paying more every year, so you need to charge more in rent, because this is a business. This isn't you doing people a favor. It's a business. So if your rental cash flows, now you have this profit that is going to be tax-free because of depreciation. So we're going to get into depreciation right now. What is depreciation? Depreciation is when you take a business asset and you spread it over a amount of time, a specific amount of time. How long you spread it, what is depreciated is all determined by GAAP rules. The length of time and how much can be depreciated and when is all already predetermined. It's not something that we can come up with. And so when you have a rental property, as it is a business, you will depreciate that asset. You won't depreciate land. You actually only depreciate the asset. So let's imagine you bought a rental for $1 million. But you're going to take 700 or 650 of depreciation because you can't take land. So if I'm depreciating this asset at $700,000, you're roughly getting like $25,000, $26,000, $27,000 of depreciation. That's going to be a yearly deduction. It's not. I mean, you probably aren't going to be using straight line, but whatever. It's you get this deduction. And so that deduction is not even you paying for, you are paying the mortgage or whatever, but that's not even you paying it. And so the income that you have from that rental is going to be tax-free because you have this depreciation. You have the expenses, so that's going to be deducted. And then you have this depreciation. So God willing, your rental is going to cash flow anywhere from 5 to 12 or 5 if you've had it for longer, or it's multifamily. Like if you've had it for a little bit longer or multifamily, you can have higher numbers than that. But really, realistically, $5,000 to $12,000 of profit in your pocket is what you're going to be looking for the rental. It's not going to be something that you're going to be able to get rich quick on. That's not what rentals are. Rentals are kind of long-term gains, even when you're looking at them as a short-term asset. For example, if you have a rental and you want to continuously raise the rent and you know you're going to be getting new renters, like you maybe do short-term rentals or Airbnbs and things like that, you're really trying to maximize profits, especially if you're doing Airbnbs and you're trying to maximize profits. Totally understandable, but you're still not going to be seeing like $100,000 of profit coming from the rental in 1 year. Like that just doesn't happen. So it's going to be a long-term game, even if you're still thinking about it as a short-term type of situation. Rental properties, though, are really great because sometimes people just need to accept their tax. Like there's not much more you can do. You have a W-2 job and there's very little you can do. You already maxed out your retirement, your HSA, You did everything. You already get your itemized deductions, charitable contributions, whatever. You did everything. Then you need to accept your tax. You need to focus on growing your income tax-free. So if you can give yourself an extra 10%, but save the same tax, it's even better. It's better than having the deduction. That's wonderful. And so that's kind of where some people may lie. Depreciation is your best friend and your worst enemy. Depreciation is your best friend if you have no intentions of selling. Depreciation will lower the basis. And so when I sell anything, I sell stock, I sell a house, I sell anything, I look to see what my sale price is and what's my basis. Basis is what's the amount of money that you were required to put into it. And that amount you subtract from whatever you sold it at, and that's how you get your capital gains. So let's do stock. I bought Apple stock at $100 a share, and I'm selling it now for $500 a share. I'm selling one share, making life easy. I'm gonna have $400 of capital gain because my basis is $100. If you have a property and you're not renting out the property, your basis is going to go up because of all of the mandatory expenses that you can't deduct. So let's say I had a second home and I'm not able to take property tax and there was a mortgage on it. And I paid $500,000 for this home. And I, over the last 10 years, have spent $10,000 on mandatory, not elective, but mandatory things, and maybe another $20,000 in improvements. And so now I have $530,000 of my basis. And so if I sell it for $600,000, bought it for $500, I have $30,000 of increases into my basis, and I sell it for $600,000. Forget the expenses. You also get to deduct the expenses, but for this sake, easy stuff. I'm going to have $70,000 of capital gain. So when we have a rental, because we're depreciating this asset, we're taking the price that we paid for the rental, regardless if you put a loan on it, nobody cares. Taxes don't care about loans because it's still you owing that money. So if you've been depreciating this asset, you're going to recapture depreciation. And depending on how much you sold it for and how much you purchased it for will determine how recapture is calculated. If I purchased the rental for $500,000, I put $20,000 in improvements into that, and then I've taken $100,000 of depreciation over the last 10 years. I'm selling it for $600,000. My basis is $500 minus the 100 because I have already taken that 100. Plus that 20. And so it's going to be 420. I'm selling it at 600. And so that's $180,000 of capital gain. There's no exclusion because it is your primary residence. And so if you own a property for a very, very long time, or you do like a 1031 exchange, or I don't know, whatever, or you're really aggressive with your depreciation, you're going to have a lot to recapture because your basis is nothing. And so when people have owned properties for a very long time, we very much go, why are we selling? Do we need to sell? How are we going to sell? And you need to be conscious of how you're going to sell it. It's not going to be as fast as if you had the property for 10 seconds. You shouldn't, because you could be taking a really big tax hit. And there are ways to help minimize this tax hit. You just need to think about it, and you need to speak with a tax advisor. You can sit down with us at no additional cost and have a consultation. We can help walk you through some of these different strategies that you can use to help minimize your capital gains. Let's talk about passive losses. So I have a job, I do taxes, I have rentals. Rentals are always going to be considered passive. Always, 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 except in one case. They're going to be considered passive. Passive losses cannot go against active income. And so if I have passive losses, my passive losses will only go against other types of passive income. Passive income could be like interest or something, like interest you earned, not interest you paid. And so these passive losses are going to accumulate, and you'll be able to use these passive losses if you sell. But 9 times out of 10 on your tax return, your rental is going to show a loss. And that's wonderful. That's what we want. That means because your rental is cash flowing and you're actually making money in your pocket, you have all this money tax free. You got the $10,000, $12,000 tax free. Yay. And so you have this loss. If your modified adjusted gross income, your MAGI, is less than $150,000, starting from anywhere between $100,000 and $150,000, that's the phase out range. If it's less than $150,000, you are able to take some of that passive losses to go against other types of income. But if your income is over 150 is the threshold, you can take none of your passive losses to go against other types of income. You don't lose the passive losses though. You just keep carrying them forward until you're able to use it, until you sell or until you have like a bunch of passive whatever, or if it's now starting to show a profit, you can, you'll be able to use it. And it's not the only time it's going to be specific to each rental is when it's a sale. So if I had 3 rentals and I decided to sell one of the 3 rentals, the passive losses from that one rental that I was not able to take, I'm going to use that to go against the capital gains that I have from that one rental. If I have passive losses from my 3 rentals and one of the rentals shows a huge profit, I'm going to use some of the carry forward passive losses to go against the rental. It doesn't matter which property, or like if one property has a bunch of losses, it can counteract the other property's profit. Like that's fine. So you need to make sure you're understanding what your income is. If your rental's in a partnership, it's the same thing. It's just going to get split between whoever the partners are. If you are a real estate professional, this is where it changes. What classifies somebody as a real estate professional? Well, there's several things that you need to pay attention to. A real estate professional, because real estate is their business, is going to be able to have rental income as active. And so, or rental losses as active. And so those losses can go against other types of income. Like if you're a real estate agent, or if that's all you do, you have 50 rentals and this is what you do. This is how you have your income. You manage these rentals. Now, because this is your main source of income, it makes no sense that you can't have this income be active. It means you wouldn't have any active income, and that's totally unfair to you. And so when you're a real estate professional, you are able to have the passive losses count as active. And so this is really, really great if you maybe have a stay-at-home spouse and the other person's on W-2 and you have several rentals. You can now have the spouse be considered a real estate professional. Like, it's a little technical and there's stuff you need to do, but essentially if the spouse is the real estate professional and the spouse is the one that's managing the rentals and things like that, then you can have some of those passive losses go against some of that active income from your W-2. But at the end of the day, we really want to minimize the spending that we're doing on rentals. It's very, very important that you don't think like, oh, it's deductible, and so I should put a new roof on. Well, a new roof is important, but I should spend $1 bazillion on landscaping, or it's deductible, so I want to paint over and over again, or I want a really nice faucet, or whatever. No, you want to make sure the thing cash flows. You want to minimize the expenses. You have depreciation that's already going to be a nice deductible expense for you. You want to maximize the profits that you're having inside your pocket, because on your tax return, it's still most likely, it will depends on how much it is, it's going to still show a loss because we have depreciation. And so minimize the spending. I mean, if you need to do spending, like, because, you need a new roof, do that. I'm not saying don't do those things. You need to maintain the property, obviously, so that you can charge the most for rent, and you need to, increase your rent as much as possible because, again, we're trying to maximize the profits. Playing the game of real estate professional is important, and something I definitely advise some clients to do, but you need to make sure you qualify for a real estate professional. How do you qualify? The majority of your income, the majority of your time, and a minimum hours you need to materially participate for you to be considered a real estate professional. Majority of your income and the majority of your time needs to come from real estate for you to qualify. And so let's imagine Tommy Joe is a coder, and he works 10 hours a week, and he has 5 rentals. Is he going to qualify as a real estate professional? Probably not, because his job coding, even though he only works 10 hours a week, is probably going to make more money than the profits that he has from the rentals. Because remember, the rentals are showing like 10, 12K of profit. I mean, multifamily obviously shows more. Let's imagine Tommy is a coder and he only works part-time and he has only done it for 3 weeks. Is he going to qualify as a real estate professional? For this year, probably, because he's only working part-time. He has multiple rentals. Managing those rentals is more than the time. The majority of his time is spent on real estate, like managing the rentals, and the majority of his income is coming from the rentals because he just started his coding thing. Next year, he might not qualify as a real estate professional. It's really, really important that you pay attention to the qualifications and make sure that you could substantiate those qualifications, because way too many people could just click a button, call themselves real estate professionals. So the IRS is very keen on making sure people qualify correctly. And so you need to make sure you could substantiate this. And there's different ways. Come sit down, talk to your tax advisor. They'll walk you through all the ways, and they'll walk you through all of the amount of risk. Because sometimes it's not even worth it. Some people are like, oh, I want to be a real estate professional. I'm like, it's not even worth it. Your property doesn't have much of passive losses. So what are we trying to take those losses to go against? Like, I don't want to become more aggressive so I can save $10 a tax. That's not good. Like, no. You need to make sure, it makes sense. It pens out, as some people say. Is that an old expression too? Am I showing my age again? Anyways, so we've talked about cash flow, real estate professional, passive losses, and depreciation. I want to reiterate, rentals are amazing, amazing things. If you want to put your rental in an LLC, that helps with liability. I don't recommend put your rental in one LLC per rental, because there's also expenses that go along with that. But there's different things you could do, and there's different strategies. Rentals should be a benefit to you. If they're not a benefit, obviously we've done something wrong and we need to readdress it. It's usually about cash flow types of things. Especially if you're a real estate professional, you might be able to do what's called a cost segregation study, but that's a whole other type of thing. Watch one of our next videos. We'll get more into a cost segregation study. All right, guys, if you have questions, please contact us. The link is inside the description, or you can go to our website, roberthalltaxes.com, and you can sit down and have a free consultation with me or one of our many wonderful consultants. Thank you so much for your time, and I wish you a wonderful day.